funding, but there's something holding you back. Maybe you have high utilization, maybe your credit score isn't as nice as you want it to be, or maybe you just don't know where to start to go look for funding. That's what we're going to talk about tonight, late night. And part of me, it's midnight, is not about to be a lot of rah rah or, motivational. It's just going to be simple, common, you know, direct conversation. We're going to keep it simple tonight. This is what we're going to start off with. Let's say you want to go for funding, but right now you're in a position where you have high utilization, whether it's on the maybe have high utilization on the personal side. We have high utilization on personal side. That's going to prevent you from getting access to capital on the business side. Because no matter what, they're going to check your personal credit. That's just what it is. Especially as a startup, they're going to check your personal credit. Now, I'm going to talk later on, going to cover some ways that you can get funding without them checking your personal credit. All right. So you have high utilization. What are some things you can do to tackle that high utilization today? You can always refinance it. Okay. High utilization is on revolving lines of credit. So that's like personal lines of credit and credit cards. High utilization does not account for loans. So with that and knowing that, what we want to do is use a loan, whether it's a personal loan or business loan, to basically pay off our credit cards. And now we have freed up the utilization on our credit cards, and this allows us to apply for new credit cards. Now, a couple of things with this strategy you got to keep in mind, as in the world of funding, especially now in this climate, every data point counts. When I say data point, just to give you a rundown, here are some of the things that lenders are actually going to look at. They're going to look at the age of your history. I'm sorry. They're going to look at the age of your credit. They're going to look at how long your accounts have been open. They're going to look at your debt to income ratio. They're going to look at your credit card usage, right? How often are you paying off your credit cards? If you went over the limit, how long have you been over the limit before you pay down your credit cards? They're going to look at how many new accounts you have. They're going to look at the hard inquiries. Every little data point matters. So keep this in mind when you're thinking about this. So if you have high utilization, what we want to do is this is just one thing we can do. We can get a loan, whether it's a personal loan or even a business loan or even a business credit card. But right now, let's say you're in a situation where you can't get a business credit card because your personal credit card utilization is too high. You can get a loan. Where are some places you can get a loan? First place you can go to, of course, is a credit union, because credit unions, generally speaking, have relatively more lenient lending criteria if you have a relationship with them, right? So if you've been with your credit union for years, you have, let's say you have like 3 or 4 different accounts with them. They see that you have deposits going in. They know that you're good for the money because they see your income, or maybe you have a business account. So they see the revenue coming in. So you have that relationship built with them. You're more likely to get some like maybe Federal, some like Andrews, some like Justice will typically give you higher credit limits than if you just went to a bank or one of the big regional banks, big national banks. Sorry. from your credit union. Use that to pay off your credits. Some other places that you can get a nice size personal loan is SoFi. SoFi used to be a fintech, now it's a chartered bank, and they will give out the bag. One of my clients who has a 785, just literally just yesterday, he got approved for a $40,000 personal loan. They actually offered him 60, but he decided to downgrade it and take 40. He got $40,000 at a 7% interest rate. That is absolutely amazing. Another place that you can get a personal loan specifically to pay off credit cards is Upstart, Upgrade, and Happy Money. Those three offer personal loans that you can use to pay off your credit cards. Those are going to be fintechs. So they will definitely check, they'll do a soft pull, and they'll let you know how much you're approved for before they do a hard pull. So they'll pre qualify you on a soft pull. They'll let you know how much you're going to get, and they'll let you know your interest rate and what your monthly payment will be before you accept the loan. That's amazing. That allows you to plan ahead so you're not guessing or running around trying to figure out how are you now going to handle these monthly installment loan payments, right? So now that's one way that you can pay off. What's good? What's good? That's one way. What's going on, Sunshine? That's one way that you can use a loan to pay down or pay off your credit cards to lower your utilization. Okay, getting a personal loan or even a debt consolidation loan. That is not to be confused with a um, debt management program. That's not the same thing. Another opportunity that you may have is if you're in position to get a business loan. Business loans typically, or a business line of credit. With those, just to give you a heads up, you typically want to be a more established business. So if you're going for a business loan or business line of credit through like Blue Vine or American Express, your business needs to be at least 12 months old. And to get a higher limit, let's say, you want to get 40, 50,000, then your business definitely, what's going on, Pop? Your business definitely needs to be generating at least 10 to 15,000 a month, because those type of fintech business lines of credit are going to lend to you based on the cash flow of your business. But the great thing about that, once you have that business line of credit, is liquid that you can transfer directly into your business bank account and then use that to pay off your personal credit cards and bring that utilization down. Why is this important? It's important to bring down your utilization because when you're going for funding, in order to maximize the limits that you're going to get, they want to see that your utilization is only between 1 to 9%. Can you get additional funding with higher utilization? Yes. I've gotten funding with 45% utilization before. But at 45%, I only got a $5,000 credit card. They could have kept that. But as soon as I lowered my utilization and asked for a credit limit increase, they tripled it to 15,000. That's the power of making sure that your utilization is low. Okay. So you could do that if you have low utilization. Now, let's say you have weak personal credit, but you have strong revenue on the business side. They have what's called merchant cash advances. Now, full transparency, I do work with lenders that offer merchant cash advances. They have their place in the finance world. It's a great way to get large limits quickly. I mean, they'll give you 40, 50, 60, $70,000 within 24 to 48 hours if you qualify. The other part though is weekly, you may have to make daily, weekly, or monthly payments on these cash advances, and the interest rates can be high. Most people go for merchant cash advances because your credit profile isn't that strong. And that's just honestly, y'all, that's the name of the game. If you have weak credit, if your credit score isn't high, if you're not over 700, 720, then you're going to have to deal with high interest rates. That's just what it is. That's why we always I tell my clients, hey, if you don't want higher interest rate, you got to increase your credit score. We can't, this is one situation you can't have your cake and eat it too. You can't have a 500 or 550 credit score and you also want a 3% interest rate. It never works that way. It's never going to work that way. But what you can do is use what you have. If you have cash flow in that business, use the cash flow in that business to boost up your personal credit, right? Use the cash flow to boost up your personal credit that will allow you to then qualify for a lower interest rate. And then you can use that lower interest rate product to pay off that merchant cash advance. Sometimes you have to make moves like that. Now, granted, you have to move quickly and you have to make sure that your merchant cash advance has the right type of repayment structure that fits your needs. I wouldn't recommend doing something like this if it's a daily. Like you don't want to deal with something like this if it's a daily merchant cash advance, right? This is more so if you got maybe a weekly, a bi-weekly, or monthly repayment terms on that merchant cash advance. Now, if you don't have to worry about utilization at all, you just need the funds to infuse directly into your company because you needed to get more equipment, you needed to buy inventory, you needed to buy marketing and advertising, then you're good, right? Put it towards that, flip it, make your return, and pay back the merchant cash advance as quickly as possible because their interest rates are very high. I mean, 30%. Some of them go up to like 50%. Like it can get crazy, but they serve a purpose. Now, another great opportunity for you for getting funding, even with weak credit, are loans loans from merchant accounts. This is different than a merchant cash advance. A merchant account is basically your payment processor. So PayPal, Stripe, Square, if you have certain online banks, they will actually look at your cash flow and start offering you loans based on how much cash flow you have going through your account. Typically, all you have to do is just be with that payment processor for about 6 months, and they'll actually start offering you loans. Stripe does it. You know, they'll just look at your cash flow and you'll just get an email and they'll say, "Hey, you qualify for a $4,000 loan. Hey, you qualify for a $15,000 loan or a $250,000 loan based on the cash flow that we see." This is after about 6 months of being with them. And the great thing is that once you've been with them for a while and they see that your cash flow is increasing, the loan amounts are going to increase. So it grows with you as your revenue grows. This is great for if you're someone with a low or weak credit profile because they don't require any credit check whatsoever. And these type of loans do not report to your credit. It's literally a ghost line of credit. So you can get a $50,000 loan that doesn't report to anybody and it doesn't have a set repayment. The reason they don't have a set repayment is because like Stripe is going to take their fee out of every transaction. They'll typically take something like 20% of every transaction until the loan is repaid. So it may only take you, depending on your cash flow, you may pay this thing back within a couple of months. Some people I know have paid back their Stripe loan within 30 days. Some people they pay it back in 6 months, just based on your cash flow and what you got going on, right? But it's still a great way to get access to capital without any personal credit check. Okay. This type of loan can also be utilized again to pay down your personal credit cards to lower that utilization so you get access to even more capital. Now, here's something no one's talking about: your debt to income ratio. This came up when I was helping a client with going for personal lines of credit. They wanted $50,000 in personal lines of credit, but because their DTI was over 35%, they the credit unions were not liking it. So we had to pivot and go for credit cards because the credit cards focus more on your credit utilization. When you're going for loans and lines of credit, they're looking more so at your debt to income ratio. It's super important that we keep track of these different data points because each product is going to prioritize a different data point. Credit cards worry about how you're using your other credit cards. So if they see one max credit card, they might deny you for that, even if your other credit cards are not maxed out. As a rule of thumb, what you want to do when you're going for your credit cards is you still want to keep up and keep track of your debt to income ratio, but you want to make sure you don't have any recent lates on any accounts. You want to make sure you don't have any recent charge offs. By recent, I mean you don't at least 3 years. Now, some banks are pressed. I ain't gonna hold you. Some banks are super pressed and they'll deny you for a charge off from 4 or 5 years ago. I've seen it. It happens, right? So work with a credit repair professional that can get rid of charge offs. Charge offs are difficult, so it may take time, may take a couple of months, but you can do what you need to do in order to get that removed, right? So you want to have a clean slate, okay? The other thing they're looking at is when you look at each individual credit card, you want to make sure that your credit utilization is under 30% on each individual credit card. So you have two levels, like if you want to say that, of utilization. You have your overall credit utilization that you see across the board, or they'll take the average of all of your accounts. They'll also are going to look at each individual credit card that you have. So we have a strategy that we like to use called all zero except one. AZEO. All zero except one. With this strategy, this will always keep you in funding territory so you can be perpetually applying for new credit. And eventually that's where you want to be. It may be a struggle in the beginning as you figure out your cash flow, as you get your budget together. Yes, I know you don't like to hear the word budget, but it is a part of it. There's no way we out here talking about how can I get 100,000, 200,000, $250,000 and there's no budget involved. We absolutely need to make sure that financial literacy includes money management, cash flow management is financial literacy. Okay. So you're going to need it, especially if you're a business owner and you planned on actually staying in business, right? So I went off on a tangent. Let me bring it back with utilization and cash flow, keeping track of that, all zero except one. With this particular strategy that we use this heavily in the credit card community. What we do and what you want to do is if you even if you have 20 cards, Pay off all your cards. Let them all report to zero except for one card. And that one card, that the utilization that reports on that one card can be anywhere between 1 to 9%. That is it. We do that because that will actually give you the most points on your FICO score. I don't know why it's like that, but that is kind of like the secret formula to maximize your FICO score. If all of your cards are paid off, you actually will have a lower. Okay, do this. Follow this strategy this month and pay off all your credit cards the next month. You'll see what I'm saying. So if you do all zero except one, you'll see that your score will go up. Next month, you zero all your credit cards, you'll actually lose points because FICO was not designed for you to get out of debt. The FICO score actually measures how you manage debt. So if you're debt free and on your journey to debt freedom, you will actually lose some points on your FICO score. You see this when you pay off a loan. So a lot of people see this, you probably seen it, where you pay off your auto loan and your score drops 20 to 30 points. It's because one, that account closed, so it took away your history, and it also lowers your debt because the FICO score measures how you're using the debt. If you're not using debt, then the FICO score isn't going to grade you as high as it otherwise would have. If that, I know it doesn't make sense. It's a stupid system, but that's just how it works, right? Trust me. Trust me. I've been to enough credit conferences and FICO conferences. It's just how it works. Try that all zero except one strategy that will maximize and keep you in position. On your debt to income side, you want to keep that below 35%. Now, unfortunately, we don't have as many amazing tricks with the debt to income strategy. That really is going to be, you will take your gross monthly income and divide it by your monthly bills, and that'll give you your DTI. Excuse me, your DTI. That you're going to play around with simply by increasing your monthly income. You increase your monthly income, that's going to allow you to lower that DTI, and of course, just outright paying down your debt, right, and lowering those monthly payments. Maybe that can come in the form of refinancing. So if you have a loan, let's say you have an auto loan that's 10%, and you can refinance it into a 4% interest rate, that would then lower your monthly payment. Since you lower your monthly payment, you then lower the DTI, and that puts you in a better position. DTI is important when you're going for larger lines of credit. This comes in handy if you're doing fix and flips and you like to have that liquidity. Business lines of credit are great for that. So keep your debt to income ratio under 35%. Okay. These were a couple of things, right? Going back to some personal loans and lenders that you can use, you have One Main Financial. Now, One Main Financial, they're kind of predatory. I ain't going to hold you. They're kind of predatory. But if you're in utilization hell, meaning you can't get any more funding from anywhere else from a prime bank because you have high utilization, then One Main Financial may be a bank or a lender that you're going to go to, right? But they have high limits. It's just what it is. If you have low credit, you got to deal with shitty options. That's just what it is. You got to fight your way out. Okay? You got to fight your way out. That's all I can tell you. There's another website actually called badcreditloans.com. Very straight to the point. There's no trickery there, right? Same thing. Something else, and this is something that my good guy Olaf shared with me, right? Some of these lenders, even though they're an online platform, some of them will accept collateral. Some of them will accept collateral, right? There are, and let me talk about that for a little bit. There are 3 C's to getting access to capital, right? 3 C's. We all know credit. We see it all the time. Get 250,000. Go to PNC Bank, get $100,000 credit card. Go to Navy Federal, get a $25,000 credit card. Go to Truist and get 2 business credit cards with 1 hard pull. All of that is great. It's a wonderful thing. That's for prime credit. Now, I understand right now a lot of people don't have prime credit. People have missed payments, people have charge offs, some people are over leveraged and they're on the edge of bankruptcy. Some people have caught themselves and now they're backpedaling. They've realized that, okay, I'm not where I want to be. I need to pivot. I need to make a change. So now they need to tackle this utilization. Maybe your cash flow has improved. You're doing what you need to do, right? With the 3 C's, they're looking at your credit, they're looking at collateral, they're looking at cash flow. So if your credit is weak and you go to some of these subprime lenders, they may accept collateral. That can be a car, it can be a house. Now, what I don't know is will they accept stocks or retirement as collateral? Right? That's a very, very risky move to put up your retirement fund to pay off some credit cards. That's a very bold move, but if you can finesse it, you can move fast enough, you know that you have a definitive play, a definitive way that you're going to make the money to pay off this loan so you don't risk your retirement. Do it, right? But plan it out. Even work with someone to make sure that your plan makes sense, because the last thing you want to do is lose your entire retirement trying to get out of credit card debt. But if you have an auto loan, they'll accept that. Some of them for larger projects, right? You want to get 6 figures in funding, then they're going to be looking at real estate, such as new construction loans or even an SBA loan. They're going to be looking at collateral, because that can offset the fact that you have weak credit. When our credit isn't top tier, if you're below 600, you have to bring something else to the table, right? The banks are not, and I say this, with as much love as possible. The banks are not charities. They're not a charity. So when we are in our weakest moment where we feel like someone needs to give us or should give us a handout or something to that effect, it will not come from a bank. The banks are not in the business of lending to people who are in financial need. That is not their job. That is not what they do. They make money from lending to people who can pay them back. Okay. So is it a little crazy? Yes. But when you think of what we want to do, start thinking about this from the standpoint of a banker, right? The banks. We can't get mad at the rules of the game. We just have to learn the rules of the game and then play by the rules. Let's see. Darcy, I was thinking of a new method to transfer my personal credit collections and derogatory marks to my business. How would I do that? You can't. You cannot do that. You cannot transfer negatives from personal to business, and you don't want to transfer negatives anywhere. You don't want to transfer negatives at all, because if you transfer the negatives to your business, then now your business is no longer fundable, right? If you put all those negatives onto your business, then your business is no longer fundable, and you're still in the same kind of position. You're still just not able to get funding. And you're doing all this maneuvering and moving around for the sake of getting funding. What you want to do is get those negatives removed altogether. You don't want to move them around. You just want to get them, gone. Collections, you can get collections removed with a cease and desist letter. You file the cease and desist letter with the CFPB, and you have the CFPB send the cease and desist letter directly to the collection agency. Um, that makes the collection agency go away. I have a 90% success rate doing that with collection agencies, right? After that, you can always find violations what that the collection agency has done and sue them. You can get in contact with a FDCPA. Yep. Yeah, it works like a charm. I do it all the time because 90% of the debt collectors are breaking the law. Like 90% of them, they're breaking the law. Right now, you got some that are stupid. And even though you send them a cease and desist, they still continue to communicate with you. And then at that point, you do have the option and opportunity to sue them 100%. Get with an FDCPA attorney, sue them, and you'll get $1,000 for every single violation. Right. I've I just sued somebody for the first time this year. I got $2,000. I was like, all right, cool, bet. And I got the collection deleted, right? They got up out of there. So that's what you want to do. You want to get rid of derogatories. You don't want to put them on your business unless you don't plan on keeping the business and you just plan on, you know, shutting the business down or bankrupting the business. Um, but unfortunately, you can't transfer negatives. All right. So you just want to work on getting those off. Cash flow. When you have cash flow, a lot of opportunities open up to you on the funding side. Granted, the repayment terms may not be as favorable as if you when you have good credit, but with cash flow, you can get 10, 20, 30% of your annual revenue in the form of a loan with no credit check whatsoever. So with that, you may have to pay higher interest. You may have to pay more frequently. But guess what? If your business needs $10,000 so that you can go buy inventory, that $10,000 is about to save your business, right? If you need 40,000 to dump into ads or dump into going on a podcast spree, right? Or getting on different shows or growing your audience, then that $40,000 is going to be well worth it, even if you have to pay a 25%, a 30% interest rate, because now you're able to 10x your audience and potentially, hopefully, 10x your business, right? What I always like to tell my clients is that everyone is fundable with the right strategy. The other thing is we got to be flexible. We have to be flexible. And I see this a lot in my clients who had really good credit, like, 700 plus, and now they're in like the sixes or they're in the fives, right? They just fell out of grace momentarily, right? It's never a permanent thing. If you were in the sevens and now you're in the low sixes and the fives, it's temporary. You don't have to stay there, right? You only stay there by choice. You can always come back up and get back up to 700. It just takes some time. But what I see is that they're so used to being in prime, they're so used to being in the 700 club that they like get upset. They actually get upset where they have to pay higher interest rates. And I'm like, we have to make sure we understand, like, hey, you don't have a 700 anymore. You have a 620. This is what it's like when you have a 620. So we hate it. This is a reminder, never get your score back this low again. That's just what that is. Don't come back down here. Once you're back in 700s, stay in 700s. If you don't like these high interest rates, right? Or the other side is have an immediate plan to flip the money that's high interest. If you're not familiar with different ways that you personally can flip your money in a high interest from a high interest loan, then it's a really good idea to get with someone who does. Maybe have a mentor in your field, right? Because there's a shit ton of ways to flip your money. Whether you invest in real estate, whether you have a cargo van business, whether you do stocks, maybe you trade stocks and futures, maybe you buy and sell tax deeds, maybe you wholesale. I mean, it's endless, right? Maybe maybe you flip Instagram pages, right? There's a lot of folks that are buying and selling Instagram pages left and right, and they're selling these joints for like $4,000 or $5,000 a pop each, whatever it is in your industry, the thing that you do that you focused on. Get with somebody that can show you how you can flip the money quickly so you're not inundated by these crazy interest rates, right? A 35% interest rate is ridiculous. But that if you're in a position where that's the only thing you qualify for, then it may be the best opportunity for you. But you never have to say yes to anything that's given. Everything is negotiable. You can always negotiate a lower rate. Maybe you can negotiate the payment terms. How quickly do you have to pay it back? How frequently do you have to make payments? You can negotiate that. If that interest rate is way too high, you can negotiate that. If you don't like the dollar amount, you can negotiate that, right? Everything is negotiable. If you have collateral, you can say, hey, I have collateral that I'm willing to use. Will this, how is this going to help? Can I get more money? Can I get more money at a lower interest rate? Can I get a lower interest rate? Can I get more money with better repayment terms instead of it being a daily, a weekly, a bi-weekly? Let me get a monthly. Like I got collateral. I know how to use it. Right? These are things that you can do if you have high utilization, if you have a less than perfect credit score that will still allow you to get the funding that you're looking for. Right? The reason I'm not going deep into where to go get funding is because it's a Google search. You can Google bad loans for bad credit. It's a Google search. There's hundreds of them, right? There's hundreds of lenders for bad credit. You got Upgrade, you got SoFi, you got Bad Credit Loan, you got what's another one? Santander. I hate Santander, but they do bad credit loans as well. One Main Financial. You got Happy Money. Who else we got? You got you can even get a credit builder loan from your credit union. Y'all know there are credit unions out here that will give you up to $5,000 with no credit check. Like getting access to capital, even with bad credit, is possible. And it's all over, right? There are, and you can look this up. I'm going to give y'all some homework. Just type in credit union quick loans into Google. It'll give you a whole list of different credit unions that offer these type of quick loans. A quick loan is a loan that is anywhere from $500 to $5,000. It's from a credit union, and it doesn't require a credit check. The only requirements is that you be a member of the credit union, typically either 3 to 6 months, and you show proof of income. That's it. Proof of income can be um, pay stubs. If you are a 1099 contractor, it can be your 1099s. It can be deposits, right? If you are a business, it can be deposits of your bank statements showing deposits coming in. It can even be like a pension check or a SSI check if you have Social Security coming in, right? Maybe you're retired, maybe you have Social Security. And with that, they will literally just give you the loan. The interest rate, again, it's high. It's not a cheap, like right now, digital credit union, they go up to $2,000, right? No, offer letters, nah. They want proof of income. That's just nah. Nope. Mm-mm. We got to be actual money coming into the bank. Um, so like with digital credit union, they'll give you $2,000, no credit check. The interest rate is 17.99%. Is that high? Sure, but it's 17.99% on $2,000. It's not a lot of money, right? Especially without a credit check. Like they don't care. You've been a member for 6 months. You've been rock with them. You've been doing deposits. They're gonna rock with you. Here's the $2,000. Pay us back in 12 months. DCU is so sweet. They give you 12 months to pay back $2,000 with no credit check. Like that's crazy. That's crazy. You don't even need 12 months to pay back 2 grand. Nobody needs 12 months to pay back $2,000. Nobody. Um, Another bank that does it is believe Unify Financial Credit Union. They do it. Credit Human Credit Union. They do it as well. There's another one, Genesis Credit Union. They also have a quick loan. Now, each quick loan is going to be different. Like DCU gives you a year. I believe Genesis Credit Union with their quick loan, you got to pay it back in like 2 months, and their quick loan is only like $500. It's something short. But then you have like Mercury Federal Credit Union that gives you like 5,000, and you have like 12 months to pay it back, right? So when you're thinking long term, because these are not instant loans, you have to be with the bank for 3 to 6 months. When you're thinking about funding, what we also want everyone to start doing is thinking long term. Build the relationship with the bank for 3 to 6 months before you start asking them for money. This will help build the rapport. This will also show that you're able to do deposits, right? Very key during this 3 to 6 months. You're not overdrafting, obviously, right? You're never overdrafting. And you want to show substantial deposits, right? Show $10,000 a month if possible. If you can't show $10,000 a month, then just have your direct deposit of your full paycheck go into that particular credit union for 3 months, and then ask for a credit card, a business loan, a personal loan, a quick loan, right? Those type, whatever product you're looking at, a business line of credit, because they're going to see these deposits going in, and you already established that relationship. You can use that to your benefit, and they will loan you based on how much money they see going through that, right? You making $8,000-9,000 a month, maybe you make $12,000 to $15,000 a month between your full time and your business, or your business. They're gonna like to see that, Even if it's 5,000, that's still $60,000 a year. That still qualifies you for a lot. You can easily get, another $60,000 in credit even while earning $60,000 in a year. When I would, I say retired, but when I left the government, uh, I was able to get $200,000 in funding while working a $60,000 a year job. Credit simply multiplies the amount of capital and money that you have access to. But it's all about how you use it. And you don't have to rush. Okay. This is this is a strategy, a long-term play that you can use. You can find all of these different credit unions throughout the country. Hint, real quick, there are over 4,000 credit unions in the country. You can find all these different credit unions that offer quick loans. Open up accounts with them, three at a time, just three credit unions at a time. Set up your direct deposits so you have direct deposits going to each of the credit unions. Within 3 to 6 months, guess what? You're in position to get funding from these credit unions, whether it's an auto loan, a mortgage, a credit card, a personal line of credit, or a quick loan. If you're someone who's still in the building stages, hopefully in 3 to 6 months, you'll be back into the 700s. But let's say you had a lot on your credit report, you're still working on it, it can take some time. In 6 months, if you're still in that rebuilding stage and you need access to capital, now you have three institutions that you can go get 500 to $5,000 from with absolutely no credit check. Even if you're only able to get 1,000 to, let's say you got three credit unions, you get 1,000 from one of them, you get 2,000 from another, and then you go to your last one and you're able to get $5,000. That's 8 grand that you got with no credit check. That 8,000 can then be used to launch your business. Or maybe you need to run ads to your business because things have slowed down. Maybe you need to buy some additional inventory or a piece of equipment or pay for a certificate or some kind of certification, right? The idea is that it's going to allow you to get access to an opportunity that's going to make you more money. One thing that I did wrong when I got access to a lot of credit is I didn't stress enough on using it to make more money. So that's just something that I learned along the way. Like, okay, you got all this credit, make sure you're using it to make more money, right? Don't just use these loans to pay off a bill or something like that, because all you're doing is moving debt from one side to another side, right? Use the debt to generate the income, or use the debt to pay off a debt so that you can get access to more capital. So you're in the rebuilding stages, you grab $8,000 with no credit check, and now you can use these quick loans to pay off a credit card. Once that credit card is paid off, maybe that's going to shoot up your score because your utilization has dropped. Now your score has gone up, and now you're back in position that can take you back up to a 710. And now that you're at a 710, guess what? You're in position to go for some business funding. Then you can get zero interest business credit cards from Chase, Bank of America, Wells Fargo, PNC, right? Truist, Comerica, First Citizens. Take your pick. Once you have those zero interest credit cards, you can use one credit card to pay back all of the quick loans. Now you're good on the personal side. You just cleaned up your personal side. You straight. You good now. You don't need to use it no more because you were able to get your business funding together. Now you stay on the business side. Now you keep using your zero interest credit cards to scale up your business. Now you can use your zero interest credit cards to pay for marketing material. Now you can use your zero interest business credit cards to pay for publicity, right? Getting on podcasts, things of that nature, or to buy equipment, right? Whatever you need to do with the cards. Maybe you need to do a fix and flip, put a down payment on a house, put a down payment on some land, right? Put a down payment on an event space that you're going to rent out. All of these are options and opportunities, whatever endeavor you're personally working on. But that's a long-term play. That's something that you can put into motion today, knowing that you'll be in position to execute in 3 to 6 months. And there's nothing wrong with that. You should be thinking about, okay, what am I going to execute on in 3 to 6 months? My credit is crappy right now, but hey, it's going to be better in 6 months because I'm actively watching YouTube. I'm learning ways of fixing my credit. I have the ebooks, I have the mentorships, I have the master classes, I got the courses, right? I have, even on my own channel, I have videos on how to freeze your secondaries. I have a video on how to remove late payments. I have a video on leveraging data breaches to get deletions from Equifax, right? I have these videos on there because your personal credit needs to be in position as a startup, if you're a startup business, or if your business doesn't have really strong revenue, they're still going to want to check your personal credit. And it's funny because in the world of business, and even when you check with the Small Business Administration, the SBA, a business is considered small until it does more than 5 million a year. So we're all technically small business owners, right? Until we break that 5 million a year mark, we are small, micro even. So until we break that 5 million mark, they are going to want to check out credit, whether it's the business line of credit, a business credit card, a business loan. They are going to want to check the financials of the owners and of the bank. I'm sorry, and of the business. So it's imperative that you get your personal credit in order. Like you have to. You just have to, right? The only way, I know some folks are like, well, I don't want to go the traditional route, right? I don't want to use the bank for funding. Cool. You can do that. That means you would then be going into a whole other world of, now you're trying to raise capital. You're asking individuals and institutions for money directly. You are pitching your idea to those people, those organizations like Shark Tank, in hopes that they're going to lend you money. So that's the world that you're going to be in if you don't want to fix your credit. If you don't want to fix your credit and you don't want to learn the banking system, you're then going to be moving into asking individual people, of course, rich people, or these venture capitalist firms for money. That's dope too. That's a totally separate process though. Has nothing to do with bank funding though, right? So that's another way you can get funding. So this was a late night joint. It's like after 1 o'clock in the morning. I'm about to hop off this thing. Does anybody got any questions while we on here? Let me see. I think I answered Darcy and Pretty. Y'all got any other credit questions, funding questions? If not, I'm gonna log off. No questions? Cool. All right, y'all. Definitely appreciate it. Listen, if this was valuable to you, like, subscribe, share this out with other people, and I'll talk to y'all later. All right. Peace.